So, Tom McCarthy, welcome to the Emotional Balance Sheet podcast.
Thanks, Paul. Thanks for having me.
Yeah, I feel like we've been not months, but like years overdue for having this conversation. I mean, I think you and I have been working together for probably close to 8 years now, ever since John Herzl introduced us to each other. So for the audience, Tom is my mortgage broker. He's based here in the state of Michigan and Metro Detroit area. And with all of the craziness of the last couple of years surrounding interest rates and mortgages, I thought it was finally due time to have you on to have a conversation, Tom. So
I'd be
thanks
I'd
for
be a
making the
lot more
time.
offended if I knew you'd have had this many episodes. Like when you reached out, I was under the impression that it was a relatively new endeavor, and then when I went on to listen to a few episodes, you were like celebrating your 105th episode or whatever. So I'm happy for you, but I'm also slightly offended. I'll let it slide.
Well, for those of you who don't know, like we're gonna get into this, but you've already seen and heard a little of the comedy that Tom brings, and when we're gonna get into that because that was interesting. The first time I actually met you, you brought this up, and so I'll keep teasing it, but we'll hit it during our conversation. But yeah,
Terrific.
we just celebrated 150 episodes, and it'll be 4 years in October is when we released our first show. So I've been pretty much a regular on the weekly schedule, if you will. So, but why don't we start with introduce us to the audience? Like, Tom, walk us through like who you are and what you do, and then we'll dive deep into the interest rate and the mortgage environment right now.
Sure. I usually start off kind of just defining, instead of myself, just kind of defining what a mortgage broker is in general. Some people have an awareness of it. Some people have worked with a broker before. The broker channel has been around for a long, long time. It is growing. Right now, brokers represent just under 30% of all mortgage originations nationally. The other 70% go to the big banks. What a mortgage broker is, most people are familiar with the basic concept of the business through their insurance agents. All of us have insurance agents. Very few people directly go to State Farm, Progressive, Geico, whatever the case may be. They go to their insurance agent. Their insurance agent evaluates their needs, looks at their profile, and will run their scenario through multiple different carriers. That's exactly what a mortgage broker does. I'm not married to any one specific lender. Based upon your area, the state, the nature of your request, some lenders may be better than others. But basically, the reason you would go through a mortgage broker is to see all of the options versus just the option of Flagstar, Huntington, Chase, whatever the case may be. One of the most important changes in our industry, too, over the last 5 years is that our compensation is now paid by the lenders that we place the loans with. We receive a flat commission from the lender. So you are not paying our fees. The consumer is not paying our fees. And it's important to know, because I receive that flat commission from the lenders, it's in my best interest to show you all the options and help you weigh the pros and cons. And as you know from working with me, I enjoy that. That's my favorite part of the business is, hey, this is what we can do, what's good and bad about it.
Yeah,
So that's what a mortgage broker is.
yeah, and I really appreciate you explaining that because I often get that question. Well, how does Tom get compensated, or how does an insurance broker get compensated? So I'm really glad that you explained that. And the thing that I've always enjoyed working with you is that you're independent. And a lot of people choose to work with somebody like me as a financial advisor that's a RIA, registered independent advisor, where I'm not necessarily married to any one particular custodian or um, financial institution. I am a fiduciary, and I am required by law to do what's in the best interest of the families I work with because I'm a certified financial planner. And I think having that ability and being able to have these partnerships like you on the mortgage side, I also have a partnership with an independent insurance broker. Um, you, because of that, like, I feel like you're just as in this with me as a fiduciary and doing what's in the best interest of my clients. And, for the last 8 years, it's been an incredible, journey that we've had together, and really making, not to go too far, but really making an impactful, um, contribution in the lives of the families that we work with.
Well, I agree, and we approach. I think the reason we've clicked and clicked with John Herzl, the individual who we met through, is I take the same approach. My customers, I hope they're customers for life. I hope to have business from their kids and their extended family. So I take that approach. Mortgages are one of those things that can give people anxiety. Kind of like me when I bring
Yes.
my, I've got 5 cars, all of them constantly need work. And finding a mechanic that you trust. I mean, I used to have so much anxiety until I found the person that I trust. And if you do that, and if you handle your business that way, grow your business that way, I love the approach. I mean, it's corny, but I am a people person. I like helping people. I've been doing it. I've owned Resource Mortgages now. It will be 24 years in September. I've been in the business now 27 years. So I've seen it all. I can generally spot trouble from 2 miles ahead, which becomes very important when someone's purchasing too. Refis are relatively easy. Purchases, there's a lot of moving parts, and you want to make sure that whoever you're dealing with is experienced and knows how to navigate them and navigate them quickly and efficiently.
So how did you get into the mortgage industry? Like, where did you start, and then how did you end up in the space where you decided to go independent and have your own firm?
That's a great question because hardly anyone asks me it anymore. So I miss being asked that question. Seems like when I was younger, I would get that quite a bit. But when I graduated from college, I moved out to the West Coast. I had what I believed was a decent job opportunity out there. But being 22 years old, my job opportunity was selling Pitney Bowes postage meters door to door.
Oh my
And
God.
I was in an office of men and women who looked like they could have been Hollywood extras, and here I am, this Midwestern kid. I didn't stand a chance. I mean, they would go into these offices and flash their baby blues and sell all these postage meters. I wasn't any good at it, so I needed a job. I was a long way from home. My funds were dwindling, and I retained a headhunter to see if I wanted to go work for a consumer finance company. I didn't even know what it was. Well, he placed me. I ended up getting the job, and it now they're part of the Travelers Group, but the company I worked with, the consumer finance arm, they financed home goods, they financed automobiles, and they did second mortgages and home equity loans. And I kind of took an interest to it, had an aptitude for it. After about 3 years in California, I moved back to Michigan, and that's when I worked for a lender initially. I went up the ladder pretty quickly. I'm grateful for it. I was a regional manager at a young age. I squirreled my money away, and when I was able to, I had just turned 30 years old. I had put away enough money and started my own operation. Um, and again, that's coming up on 24 years ago. So needed a job. The job I stumbled into, I enjoyed, and here we are all these years later.
And so that would have been like, you would have had your kids when you started your firm, right?
Yes, my wife was 5 months pregnant with our daughter when I left my relatively cushy regional manager job with a lender out of Pennsylvania. She said, "You're going to do what?"
I was
But
gonna
I
say,
knew
how
at
did
that
that
time,
conversation go?
well, she trusts me. Everyone needs to have a great partner in life, and I lucked out, and she always believed in me. I had a decent track record at that time in terms of providing and making the right decisions, at least as it pertained to business and finance. And she was entirely supportive of it, and it was scary. I know you went out on your own not too long ago, or completely on your own,
Mhm.
and it's intimidating, it's scary, and it's funny. I was, as I said, just turning 30 years old when I did that. I had a lot more guts and nerve than I do now. I'm glad I did it at that age, but through her support, the first half year was relatively dicey. We were coming close to depleting the funds we had put away, but then it just started going up like a rocket ship, and had one good year after another up until 2007, 2008, where it took my lumps quite severely, as I've told you before.
Yeah. Well, that's one thing that we definitely, and that's why I wanted to pry on that question a little bit, because that's one thing that we have in common, are very supporting spouses and partners, because TAMMA does not exist without my wife, Teresa. The support that she has given me over these 15 years, or well, I guess 14 years, because it'll be 14 years in December when the triplets were born. Literally, this the day I filed all my paperwork and the business was formed. Um, but yeah, I think any solo entrepreneur, uh, there's a really, the backbone is that supporting cast, and yeah, I'm really lucky to have Teresa as part of this as well. Um,
I don't think I knew, I don't think I knew, I had known you for maybe half a year before I realized that you had the triplets plus one, and it just blew my mind. I mean, you were so together and so professional. Little did I know that you had, because at that time, I think the triplets must have been 6 years old. They were
yeah,
young. I think they were just starting school when we started doing
yep.
business together. So uh, you've done a great job balancing, uh, and maybe you're a good actor at times.
Well, maybe. I think, that's the word that often comes up on the show, is the word balance, and I'm not a big fan of it. I like the word harmony, because I don't think that as entrepreneurs, as business owners, or even people in general, are ever in balance, because there's always an aspect of your life where, for example, my kids need me more today than I can give the business. So they're in priority.
Yeah.
And then there's other days where the business needs me more that day than I can give to the kids. So the business and my TAMMA families are the priority that day. So there's everybody, I think, has this vision of this, equilibrium, this level teeter totter. And I've never seen it that way. And
Yeah.
Teresa and I have always had this phrase where we're just going to take things one day at a time. And that was 13 and a half years ago, because that's the only thing that we knew.
Yeah.
Um, and it's been the same way with the business. And I think what's really cool about how things have grown and developed is that, like, every piece of the business has been measured with every footstep those triplets have taken, and vice
Mhm.
versa. And I think that's a really cool thing about being a part of TAMMA and telling the TAMMA story and getting involved with families, because just like you are intricately involved in the financial data that
Yeah.
people have. Like,
Yeah.
in order to get a mortgage, they're sharing tax returns, they're sharing very private and personal financial information.
I would I would rather have people see me stark naked than review my credit report, and I got nothing to hide. But yes, it's a very personal and intimate to do my job. One of the first things I need is your social security, and then I need your tax return, and then I need your W-2. So, and I take that trust very seriously, and I understand the trust that somebody is giving me working with the data that I do. But I'm appreciative of it, and I think when people speak to me and know where I'm coming from and know the information I need to do my job properly, I've just always appreciated. There are some clients to this day who will give me just kind of an abstract idea of what their credit scores are, what their income is, and while I respect that, I can only give them abstract answers with that type of data. So, it's necessary. Same with you. Until you see a person's whole financial picture, it's hard to give them good counsel and good advice. So I've always said that the number of similarities between what we both do for a living are numerous.
Right. And I think that's why I think we work so well together, is we have that mentality of family first, fiduciary, and doing what's in the best interest of the people that we work with. Um, so, oh my gosh, what a freaking roller coaster interest rates have been on the last
Yeah.
couple of years. I mean, you've been around a little bit longer than I have, but I guess my first question is what's your take on this? Like going from like zero interest rates with the Fed to whatever we're at now, 5.25. But in your world, going from a 30-year fixed interest rate of less than 3 to more than doubling that up to like 8%, I think was the high that we got up to last year.
Yeah, I think the biggest thing that caught me off guard and many people in the industry was how rapidly they rose. In the time I've been in this industry, this is the third kind of significant cycle that I've been through. So that's not new when you look at the data and you look at history. What was unusual is rates doubling in 90 days, which is essentially what they did. Big picture and perspective wise, the 30-year fixed is still within the range of where it's averaged for the last 30 years. Going back to the early 90s, the 30-year fixed has been either side of 6.25. Some good news today, it is down to 6 7/8. If you've got credit scores above 640 and are putting a little bit down, you can now get below 7%. So that's good news. They do appear to be headed in the right direction. I do not think that they're going to go back to the levels that they were, say, from 2019 through 2022, because remember, there was a worldwide pandemic thrown in there. There was some very unusual circumstances. I don't think they'll go back to that level, but I do think it's reasonable to expect in the next 18 to 24 months that the 30-year fix will be back down into the 5% range. Psychologically, I think that's going to be huge because the biggest issue we face right now too is just inventory. There's so many people who would
I'm glad
like
you're
to
bringing
move
this up
on.
because this is a topic I wanted to get on. So sorry to
Yeah,
interrupt.
there's so many people who would like to move on, whether downsizing or buying their forever home, whatever the case may be. But if you've got a $300,000 mortgage at 3% right now, you're going to be hard pressed to buy a home at 600K at a 7% mortgage. So I get that. But after I hear your thoughts, which I value, I only brought a few notes to our conversation, and I'm going to share those, just sharing a little bit of perspective about rates. But it has been a somewhat unusual climb, but not increase in rates, but not unprecedented. And they have shown signs of softening. And I do expect the Fed meeting here at the end of the month. I think there's a good chance that we could get a 0.25 percentage point drop, which is psychologically will do a lot.
Yeah, I think in terms of what a 25 basis point cut will do to the economy is really an afterthought. I think it's the psychological aspect of, okay, now we're going to get into this cutting cycle.
Mm-hmm.
But back to what you were talking about, like you have your kids are older than mine, obviously. But we deal with families all across the life stage spectrum. And I think home affordability is a big issue right now. And, we've had side conversations about this. And, part of what I do as a portfolio manager within TAMMA is looking at trends. And, it depends on what research report you read. It could be 4.5, 5 million homes that we are short of right now. And so what does that mean? And if we're under that, and there's such pent-up demand, or still pent-up demand, why aren't there more housing? Why isn't there more housing going up?
Well, it's complex.
Right. And there's no one answer to this.
It's the margins for builders, and many of the largest builders in the country are publicly traded company. They have to disclose their data. The margins on middle income housing are not as significant as they are with the higher end properties. So the incentive for the builders isn't necessarily there, and the interest rate dilemma kind of exacerbates that. So that's complex. How does that work itself out? It would have to be a generational housing boom to put supply and demand back in sync. And especially wanting our children to have what we've had, the American dream, home ownership, which I think is essential to, I mean, look at how many of your clients, how much the equity in their home is part of their net worth. You have to be able to afford homes. But until there's a little bit more cooperation from the interest rate market, and until there's some type of, will it be competition? What will it be? I don't know, but there needs to be a huge, huge boom in middle income housing. And I'm at a lack for answers as to where that's going to come from in the near future.
Right. And I'm the same way. We just talked about psychological impact. I think a lot of these builders, whether they're bigger, publicly traded, regional builders, local, small business builders, they still have the scars from 07, 08,
Mhm.
and are very gun shy. And I think that's probably one of the, again, many things. It's just not one thing that is contributing to this shortfall right now. There's a lot. And so selfishly, this is where families I work with depend on me to figure out, okay, are there opportunities within the market, within specific companies or industries that could ride this trend? And of course, you and I have talked about this, like there are home builders, there are home suppliers, there's a lot of different industries that support the housing industry. And I don't know what the exact number is, but the housing industry makes up a significant portion of our overall economy.
Mhm. Yeah.
Being from the Motor City area, it used to be autos. Well, it's
Mhm.
not as much anymore, and a lot of that is automation. And
Yeah.
so, home builders are trying to figure out how to build these um, entry level, mid level houses with more automation, and that's just
Mhm.
not there right now.
Yeah. It's the one thing. So the pessimist in me says, well, gosh, this is a pretty significant issue that's going to face us for the next generation or so. The optimist in me thinks about all the challenges that our country has worked through over the years and has figured it out, and we will. And who's coming after us? Our kids. They'll figure it out. But I desperately want my kids to be able to. We bought our first home when let's see, we were both 28. My wife and I were 28 when we bought our first home. We did well in that home, and it allowed us to build the home that we're in now. Um, I, just like everyone else, wants that for their children, and we'll figure it out. But right now, there definitely are some challenges. You will see some instantaneous movement in the inventory issue when we get a little bit more cooperation on rates, which I don't think is too terribly far in the future.
Yeah. Warren Buffett has this phrase where he says it's always morning in America, meaning there's people out there in this country that get up every day trying to make this country better and the world
Yeah.
better for that aspect. So I as I've grown as a person and as and part of this business and part of this TAMMA family community, like that's one thing that I have tried to change my mindset to become more optimistic,
Yeah.
because it's easy. The smart thing is to sound like you're a pessimist, but long term, being an optimist, I've got 100 years of stock market history that says, don't bet against the people of the United States.
Sure.
Um, one of the interesting things about current level or existing home sales versus new home or new build sales is that the correct me if I'm wrong with this, is that the home buyer or the home builders have been able to say buy down or reduce down that initial interest rate. Am
Mhm.
I right on that? And can you explain that, Tom, like how that works?
Well, there's full disclosure, I have some bias against it because it's affected my business detrimentally. When I go against a builder who can give an incentive,
Right.
It can be difficult from a competitive standpoint. But what builders who carry their own financing or have their own financing arm can do is oftentimes they can buy down the interest rate or waive costs. What is very common is um, they will reduce the end price of the new construction, 10, 15, $20,000. I've seen it as much as that. Um, I guess from a consumer standpoint, just being around the block a few times, whenever somebody's giving me something for free, I immediately go to think, well, what's the true cost? So
Right.
think about it. If a builder's going to if a builder's going to throw in custom cabinets and drop the price of the home $15,000 for you to take their financing package, what's in it for them? So that is something that the builders can do. They can apply savings to buying down an interest rate. I've seen that before too. But you really have to. It would really take a professional to weigh the pros and cons of it. Not to say that in every instance it's wrong or a bad decision, but it would really need some professional analysis that I don't know that consumers always have the time for or even think of. I hope
So
that
if
answers it.
Yeah, no, that was good. If we go back to this, hopefully, um interest rate cycle that's at the knocking at the doorstep, and we see mortgage rates start to come down, does that mean we're gonna like are we gonna see a flood of new inventory come on? And if so, is that going to increase home prices, decrease home prices? Obviously, lower interest rates makes home affordability um, easier, but that's the one question I'm trying to get my arms wrapped around is like, okay, once interest rates decrease, are we going to see like another, surge, an even greater surge in demand?
I think it's potential that we could. I don't see the dynamics of our economy and the whole financial structure of mortgages are so different than they were in 07 and 08. It will not be a repeat of that. Values will not go down. I don't think they'll. Personally, they've risen so much in the last couple of years. I don't know that they'll keep up at this pace, but I don't see a softening of the market. But I do think that reduced interest rates, because it's not just reduced interest rates for the consumers. When the Fed takes action and interest rates lower across the board, it's every segment of society that can benefit from it. Builders on their huge lines of credit will get better terms. Everybody in the business channel will get better terms, which in theory should free up production and increase housing starts. Somehow, some way, if we can get housing starts to increase and interest rates to come down 100 to 150 basis points, I think you'll see a whole different landscape out there to the positive.
Yeah, that's what I'm kind of curious about, like to see, um, how that ends up playing out. Um, so for those people that you'll have to get a mortgage today, are there things that you can do within your independent framework on bringing down the rate, or obviously there's such thing as buying points and things like that. Um, but walk us through, like, if an individual has to sell their house today, they have to move somewhere else, and they're going from say a 3 or 4% rate to a 7% rate or 6% rate now. Um, what what can they do? Is there anything they can do?
Well, sure. First off, perspective and calm the nerves a little bit, which I'm going to circle back to that here in a moment because those are kind of some of the only prepared notes that I have. Um, the statistically, statistically, the average life or the average term of a 30-year fixed conventional mortgage, and this data goes back almost 30 years, is slightly over 4 years. So think about that. People get so anxious about this 30-year mortgage. It's not like our parents or our grandparents. I guarantee you, my grandparents walked their 360th payment to the bank when they paid their house off. Okay.
Yeah.
But over the last 30 years, as financial instruments have become more sophisticated and the mortgage channels have, the average 30-year fixed rate mortgage does not last more than 48 months. People
Does that include
refinance.
refinancing too? So say I take out a 30-year
Exactly.
and rates drop, and then I refinance that.
Yeah.
That just
Yep.
resets that. Okay.
Well, I'll ask you this. You're one of the sharpest financial minds I know. What's the longest you've been in a 30-year mortgage for?
Oh,
The same. I'm saying the same mortgage without refinancing.
man, that's a good question. It probably isn't much more than 3 or 4 years. I
There you
think I
go.
think right now, well, we refinanced ours from a 30 to a 15.
Right.
I think probably like in 2020. So maybe I'm on my longest one right now.
So you're going on 4 years. So the point I'm
Yeah.
making is generally we refinance to draw cash out. We refinance to go to a shorter term. We refinance to capitalize on a lower rate. We sell our homes and upgrade or downsize. So the point I'm making is you are not married to a decision for the next 30 years of your life. You're
Right.
married to a mortgage term and contract that likely, if you were to close today, the life expectancy of a mortgage today, because we are finally on the backside of this interest rate spike, statistically, you're not likely to be in it 18 months from now. So the point I'm making is let's take some of the anxiety down. Let's not look at it emotionally. Let's analyze the data and weigh the pros and cons. Okay. So and that's a great segue. Thank you for setting me up. And this is not pre-planned, people. We did not do a run through of this. But a lot of what I have to do now is share perspective with borrowers. Okay. So this scenario right now, where are my notes? Okay. This is actually one I priced yesterday. And the borrower has been shopping. I think the first time I issued a pre-approval letter on this borrower was in January. They're looking at in the $450,000 range. They've got about 50K that they're going to put down. So they're looking for a mortgage of 400,000. We priced it yesterday and it was at 6.875. So 6 7/8 is a 30-year fixed. It would give them a principal and interest payment of $2,672 a month. Okay. Their feedback was that if they find something that knocks their socks off, they're still going to offer on it. But their thought and their inclination is to wait until rates drop to about the mid fives, 5.5%. And I asked him, I said, well, why is that important to you? He said, it's going to be so much more affordable. Well, here's the reality. 5.5%, that same loan at 5.5% is $2,271 a month, a difference of $400. Now, I'm not making light of $400. That's a significant amount of money. But keep in mind, to qualify for a mortgage of that size, you need to have minimally about 180K in gross wages.
Yeah.
So think about, and the home in the area that he's looking at for the last 3 years, homes in that area have appreciated at a minimum of 5% per year. So perspective. Is $400 a lot of money? Would you prefer to pay lower? Sure. But for somebody making 180K, that's not literally, you could go out to dinner 3 or 4 less times per month if you needed to make up $400 a month, right?
Yeah. Yeah.
Or cut your
Exactly.
streaming services from 8 to 5, get rid of Max and Hulu. And if he were to purchase now, you could almost guarantee that $450,000 home appreciating at 5% per year is going to be worth $472 12 months from now. And this borrower would have paid $4,800 more for an increase in 22K, a net of $15,000. You're better at the math than I am. The point I'm making is that's a pretty extreme example too. That's a fairly large loan amount. But what I think people need to do is analyze the data of this figure they have in their head. If rates were only such and such, if rates were only such and such, I would do something. In some cases, it does make sense to stay where you're at. But in a lot of cases, if you look at it on balance, you still can make the argument for purchasing now if you're able to.
Yeah, and I think you touch on so many great points there. It's like my mind's like just churning. I'm like, okay, well, where do I go here? Because I think people are, I think this is where this again, with what we do, people think it's all numbers, it's all data driven. But I think the large part of what we do, 80% of it is all emotional. It's all behavioral.
Yeah.
Really, it is. Because we have this anchor bias. We are so anchored to a 3% or even lower, you know, mortgage rate that, like you pointed out, and I agree with you. I don't think those are coming back. Even like
Mm.
once we get through this next cycle, like those, it'll be hard. Like something, and this is the thing, is something very, very bad would have to happen to have rates go that low again. And do we
Yeah.
really want that?
No,
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 no, not at
no.
all. Um, but this touches back on what we were just talking about. In your example that you just gave, which I think is tremendous. I'm glad that you brought an example like that. Is that if they find the place that they don't want to, that they want to buy today and don't because interest rates are lower, what's the chances that that house is going to be there when interest rate drops and more people are on the market? That's
It's yeah.
that's this conundrum, I think, that we don't know. We have no idea how it's going to play out. Is interest rates come down, demand comes back, with a vengeance, and do we get enough inventory to keep up with that demand? And if not, then supply and demand, basic economics, prices should continue to go up.
I um I was thinking, as I shared with you, I listened to your last couple episodes, and even though you articulate it differently, the title of your last one, um, when does cost stop becoming an expense and start being an investment?
Yeah.
I just articulated my version of that. The cost of
Yes.
procrastination in the mortgage industry, the cost of procrastinating, you can actually assign a dollar value to it. So this particular client, and certainly I hope he moves forward. We've put a lot of work into it, and I think there's a great opportunity for him. But there's a true, if he doesn't purchase now when he's able to and waits a year, he probably is going to lose out on $15,000 to $25,000 of appreciation on that prospective property. And that's a significant. That's now we're talking significant amounts of money. We're not talking $400 a month. We're talking, a measurable amount of money that could have some impact.
So the other thing I think of in this example too is you get the house today. Yes, you're paying more because the interest rate's higher, but then as rates drop, then this is where somebody like you comes into play, or ideally like the two of us working together, where I'm watching rates, you're always watching rates, we're always in communication, and we know where people are at. I know you probably have a elaborate spreadsheet where
Yeah.
I know this person, like the Schuberts, who are family office clients of mine that moved
Yeah.
from
Mhm.
Michigan to Florida. Didn't have a choice. They were moving. They had to
Mhm.
pay what the
Yeah.
rate is. And so they're always constantly on my radar about, okay, when rates drop to a certain level, then when does it make sense to refinance?
It depends. It depends upon the loan amount, and because I'm in it for the long haul and I want to give good counsel and create relationships that last until I'll never retire. I love what I do. And if I can write loans until they're throwing dirt on me, I will, but it's in my best interest. There's lots of times I have to say no. If you're in a loan amount in the 450 to 550 range, you really need about a 3/4 of a percentage point reduction in rate for it to make sense. If you're in a
Okay.
lower loan amount, if you're in, say, a 250K, you're probably going to need about at least one, if not 1.5% drop in interest rates. So it's very dependent upon your loan balance. There's not one rule of thumb. So you need to evaluate that. And also, I'm dealing a lot with this I'm still relatively busy this year because I turned on my VA and FHA sponsorship again. So I'm doing quite a bit of government loans this year. And the VA rate now is about 5 3/8. It's tremendous. And I'm dealing with a lot of VA clients right now who are at 6.5, 6 3/4, and they can get 5 3/8 right now. It's really relatively simple. But I've had several in the last couple of months who, of course, I'm paraphrasing here, but they basically say, well, I can't save as much as I wanted to, so I'm not going to save anything at all. And I can't disagree with that strategy more strongly. We don't know where rates are going to go. If you've got a $250,000 loan amount and you're at 6 3/4 and you can do 5 3/8 today, do it. Take the money and run. But that's one of the biggest frustrations I have when evaluating refinance scenarios. Well, Tom, I thought I was going to save more, so I won't save anything at all. And that's frustrating. I wish I could find a way through.
So before we pivot, because I've got to be mindful of your time. I know I could keep talking to you all day, but is there anything else on the mortgage side of things that you wanted to cover or make sure that the audience maybe knew about?
Yeah, just one final thing from the mortgage side. Right now, when it is very likely, and the data supports that we are finally in an environment of decreasing rates. If you close on a mortgage now with me or anyone else, you will have options of lower rate, higher cost, higher rate, lower cost. In an environment of decreasing interest rates, where the likelihood is that you will be refinancing the loan you close on today in the near future, 12 to 18 months would be my educated opinion right now. Go with a package where you're paying as little as possible for it. Because if let's say that you pay an additional $5,000 in closing cost on a $400,000 mortgage to save 0.5 percentage point in interest, you would need to be in that loan for a good 48 to 60 months for that to make sense. In a loan where you paid little to no cost, or even pay a slightly higher interest rate to have the lender pick up some cost on your behalf, that loan, if interest rates 6 months from now even go down by 0.5 percentage point, it makes sense to restructure because you paid nothing for it. So the analysis of cost versus rate up front are more important than ever in an environment that we're in now. And that's part of what I do. That's part of my service.
Yeah, and I completely agree with you. I'm really glad that you pointed that out, because that kind of goes back to that refinancing question is, and we didn't necessarily talk about buying points, but that's basically what you're talking about is putting, paying more upfront and cost for that lower rate. And does that necessarily make sense? And again, this is where home ownership, we talked about the average, mortgage, 30-year mortgage duration is only 4 years, but that doesn't mean that you only live in that house for 4 years.
Right.
And so it's trying to think about your own personal, that's the thing, is personal financial planning is it's more personal than it is finance. And so
Yeah.
I think that's a really key thing to point out is, like, where do you think you're going to be, 5 years from now? Are you still going to be planning on being in that house? I mean, anything
It's kind
can
of a corny
change, but
phrase, but sometimes the corniest phrases, they're part of our language because they make sense. And I've been hearing this since I started in this industry. Marry the home, date the rate. Marry the home,
yes.
date the rate. It's corny, but it's true. You get the home, be happy with the home. The rate will work itself out. The likelihood that you're going to be paying higher than you'd like is relatively rare. And you're certainly, if you can afford a home today, it's not going to get any more expensive on you.
Right. So I've been teasing this pretty much throughout our conversation. Is I remember the first time that we actually met, and I think we've only met like twice. Has it been twice, or has it just been the one time?
We've only met once in person. We had
Yeah,
lunch the holidays a few years ago.
yeah. And so Tom and I are having a casual conversation. I don't even know how it got brought up, but I find out about this second career that you have, which is in comedy.
That's
So
right.
as hopefully my teasers audience and those watching on YouTube, you could pick up on that. But walk us through, like, how did you get into comedy, and what is that like?
Well,
And what kind of comedy?
well, to put everyone's nerves at ease, no political comedy, no religious comedy, none of the real hot topics, touchstones that some people touch on. But I'm a storyteller. I tell exaggerated, goofy stories of my life, basically. But as I mentioned, when I started, so when I moved to the West Coast, I did comedy a bit as a teenager and in my early 20s and in college. And did okay at it and thought, well, I'm going to be a superstar. So I moved out to California, literally a couple weeks after graduating from college, moved out to California, thinking that I was going to be the next great big comedy superstar. And then I moved back to Michigan 3 years later as a mortgage broker. So, and then as my
But
business
you'll
started to
never
grow,
regret, you'll never look back. Sorry to interrupt, Tom. You'll never look back and regret that decision, will you, though?
oh no, life, I'm a big firm believer of life happens the way it should.
Yeah.
And it
Because
wasn't
I
all
was the
doom and
same way.
gloom.
Most people never knew that my first job out of college was working at the ocean course at Kiowa Island and down in
Yeah.
Charleston, South Carolina. Because I was a huge golfer growing up, and that was what I was going to do. And I knew I was never going to play on the PGA. I was never that good, but I just wanted to be in the golf industry.
Yeah.
And fortunately for everybody listening to this, that job did not work out, but I never regretted going.
No,
Sorry,
and you
go
don't
ahead.
regret it. But when I came back to Michigan, it just, my business was starting, my family was, and just life was in a different place, and I quit doing it. So I literally went almost 15 years exactly between gigs from 1994 to 2009. And I just had an itch. I just kind of wanted to get back to it a little bit and express that part of me. I'm a creative person who isn't in the most creative line of work. There's a lot of numbers and data. So I started doing it again as a fully formed adult with no pressure, no expectations, and it went way further than it did when I was a kid. I've been touring around the Midwest now for the last dozen years. I've headlined most of the big clubs in the region. I put out a record a couple of years ago, and I love doing it. And I used to keep them separate, but as it turned out, I would have clients at shows and say, "That's my mortgage guy." So I figured, what's the sense? But they're just remember, if anybody wants to check out any of my material online or on YouTube or come to a show, I would love for you to do that. But just remember, that's a character I play up there. He looks and sounds like me, but that's a different.
So, so let's stay on that for a minute because I want to go back to a question on your family. So, what is the best way for people to follow both sides of your journey, the mortgage side and the comedy side?
Well, I'm very proud of one of the things I've done. This was more last year that I started when business was slow, but from a business standpoint, I've invested a ton in a really cool new website. It's highly functional, everything you need to know, gadgets, information, application links, resource-mortgages.com. So
Okay, so I'll put a link in the show
please
notes
do. Resource
for that.
mortgages.com. Resource Mortgages can also be found on Instagram and on Facebook. And then for the comedy side of me, I keep my website is tommymccarthycomedy.com. And you'll see all upcoming dates and some links to my album and videos. And then you can also find me on Facebook. So, yep.
Okay, awesome.
And
So
you need to come out to a show. The Herzls, that's how I met. You're in the family tree of comedy, whether you like to be or not, because kind of one of both Paul and I's mentor that we met through, the way I met John Herzl was from one of his twins. He has twins.
Yep.
Adam was a stand-up, very, very funny guy, stand-up and an improv guy. And he became one of my best friends on the circuit. And when he found out that my day job was mortgages, he said, "Well, my dad's a finance guy, CPA, you should meet." And gosh, I met him years and years ago. And I'm so glad that I did. And that's how I met you. So
I tell people this is the most serendipitous industry life that I lead because
yeah.
I have no idea like when people like knock on my door looking for help. And when somebody knocks on my door, I eventually learn like what drove them to finally like pick up the phone and call or meet because let's face it, no one wakes up in the middle of the night in a cold sweat thinking, "Oh my God, I've got to have a financial plan." It doesn't work that way. Something in your life happens that kind of finally pushes you, forces you, drives you, nudges you into reaching out to somebody like me. And but the other really just incredibly awesome part of building this business and this lifestyle has been meeting people like you and John Herzl and Adam Herzl. And like, I could go on and on about all the wonderful people that I've met in this industry and what I do who've become partners of TAMMA. Like people
Yeah.
know that I'm a solo advisor, but what
Hmm.
they may not understand until they really get to know me is that I have a whole team of people on the TAMMA family, if you will, and you're certainly one of them. And I'm very grateful that you've been a part of this journey with me and being such a supporter and resource for all the families that work with us. But yeah, I had so many stories about how I just randomly seem to meet people like
Yeah.
you that end up turning into being um you know business colleague isn't the right word, but yes, we're business colleagues, but we're friends on top of that. They're like we'll randomly pick up the phone and just touch base with each other because it's been a month or so since the last time we talked. And meeting somebody like John Herzl at a
Mm.
financial planning event at a bar was incredible. And like so many relationships that I have
Yeah.
today stem from that one meeting with John Herzl at a bar.
Well, totally agree. Yeah, and I can't thank you enough. The number of terrific clients I've met through you over the years, they're a reflection of you and your business, and love being a part of it. And we need to do this more often.
Well, yeah, I won't wait another 150 episodes to have you back on. So once things maybe start turning and we maybe have some idea of like what direction, not only the interest rates are going, but really the byproduct of all that's going, yeah, we'll be due for another conversation here soon.
Oh, absolutely. And we need to make a point of it. I know we're out of time today, but we really need to get out on the golf course.
That I avoid like the plague. Like my neighbors who are all clients of mine, I was just up north with them this past weekend, and I was able to get out of golfing the 2 days, but I was able to make it up there for I'll call it our bar night and then our boat day on
Mhm.
Saturday. And I'm really glad that I did, but I'm really glad I missed out on that golf because I don't like golfing anymore.
I don't, I'm a glutton my game has gotten barely better in 20 some years, but I've gotten better mentally that I just enjoy it. I enjoy being out on the course. And I went out last night. I played so poorly on Sunday with one of my good friends, and he's a really good player, and it was just pressure and trying to do things that I couldn't. So I went out by myself last night and just had the time of my life. Played 13 holes before the storms came, and I played so much better than I did on Sunday. But of course, no one was watching. It's like a fishing story.
Right. Right. Well, you know what? We kind of got you kind of got me off track a little bit because I was like, wait a minute, there's something I'm missing. And it's my closing question that I ask pretty much all of my guests, knowing that you have a couple kids, two, right?
Yes. Uh-huh.
Okay. I'm like, I don't think you have that third one yet, and I don't think you probably will. Um, what is the best thing about being a parent?
Wow, that's depending on when you hit me with that question. It could be more difficult than other days, but today it's optimism. I was thinking about this morning. Just with when you have children, you you have to be an optimist. And when you have good kids, which I'm grateful to have, it makes you more optimistic. There's a lot of people, I think it's human nature that you kind of slag the younger kids in the generation. Yeah, they do some things differently. But the number of sharp kids I've met through my 24-year-old and 20-year-old, they just blow my mind. They're more complex people because the world's more complex, and that gives me hope. So the best thing about being a parent is optimism. That truly makes me feel more optimistic than I would.
Well, Tom, I love asking people that question, and mainly because everybody answers it in such a unique way, and and like yours, no one's ever talked about it that way. But that is the one thing I will take away from this conversation for sure.
Oh,
I can't
terrific!
thank
I've
you enough.
enjoyed it.
I can't thank you enough, Tom, for being on the Emotional Balance Sheet podcast. And like I said earlier, we'll try not to make it another 150 episodes before you're back on.
All right, thanks again, Paul. Take care. Bye bye.
Thanks.